Welcome to the Closing Beat, a live show where we cover the stock market, financial tips to get your dough straight, and sometimes Disney World. Wait, seriously? Disney World? All right then. The Closing Beat, presented by Jazz Wealth.
Yes. How we doing today, everybody? Happy Wednesday. I forgot the day for a second, if I'm honest with you. Kind of forgot what it was Wednesday already. The week is going by quick. Did I mention that on Tuesday or yesterday? Well, it feels like the week's going by quick already. How you doing out there? We're financial advisors here with Jazz Wealth, and financial advisors that like to spend time talking about the stock market and not whether or not we're wearing underwear or not. That is actually a question that another advisor has asked me. Hey man, you wear underwear when you do the show? I'm like, yeah, of course. Why are we talking about that? Oh, that's the kind of thing that goes on, man. You know how it goes. Hey, we've got a little bit of a rally today. Thanks, Uncle Powell. We were certainly happy to see that. And that puts us back into a known downtrend, so we'll cover that here in a second. First off, I want to share with you guys home buyers. Congratulations, home buyers. You guys, a little bit of good news out there, and Jerome Powell helped out with that today as well. We've got rates moving lower, and I'm going to pop over here real quick and see if I can just share that with you. Rates, so bonds moving higher, rates moving lower. That's a good thing there. The national average interest rate on a 30-year mortgage went from 7.35% to 6.78%. That's still 20-year highs, right? But it's a drop of more than 0.5% in 20 days. That doesn't happen. In fact, the only other time that we've seen something like this, which means a drop of interest rates by 0.5% in 20 days, was 2008. Other than that, it's never happened. So really kind of cool there. This is the second time ever in history. So there's so many things this year that we're seeing for the first time. If you are new to investing in 2022 and you're like, I don't know, let's give the stock market thing a try. You wait till you see 24, 2025, 26, and so on. We go through some calm years. You're going to be like, boy, I made it through hell and back. That was cool. All right, so I want to share something here with you. We'll go over to this page here so you can see home prices. Just did a little fun thing here. What's the percentage gain by area since COVID? Tampa ranks #1 right here. Hometown, baby. We win the game. Up 67% since COVID, home prices. And it's really obvious around here, too. Like that, I totally believe the number there. This is actually from the Case-Shiller numbers there. Phoenix 63%, and then Miami gets 63. If you take just the composite 20, the 20 largest regional areas there, 39%. And if you take the 10 largest, 37%, so basically the same. DC 27%, Minneapolis 29%, San Francisco 30%. Very, very crazy to see the number of gains there, right? We got a 4-week increase in the new mortgage applications there, which that's interesting. It's been about 4 weeks since rates have fallen about 0.5%, and at the same time we have new mortgage applications going up. Granted, still very much at new lows, or at very all-time lows there, but it's trending in the right direction. Shows that people are actually watching for any pullback to pull the trigger on buying that property, just assuming 0.5% is a better rate there. So just wanted to share that with you. You still have mostly massive gains in the housing market. Hey, that's pretty cool, right? That's pretty cool. Let's go on over to the S&P here. There we go. So we got a little Jerome Powell rally, right? That takes us back up to our line that we've left here for some time now to show the market in a clear technical downtrend. Whether you believe it or not, that's exactly what's happening here. And we have been looking for that catalyst to move us higher. Well, the catalyst of having a 0.5% rate hike in December, that's coming up here very soon, is partly to help there, right? Also included will be a lot of the economic news that's been coming out that I covered on Monday. We saw that last week where a lot of the econ news was really good and the market really just barely pulled back on that news. Well, now we find ourselves up at this high and we have to ask ourselves the question, are we breaking through and clearing out this year-long downtrend, or are we just going to, peter on back here towards 4,000? I don't know. right? We'll see what happens there. But I will maintain the same comments that I've had, that pullbacks would be buyable. I'm not saying, that this was a pullback here and somehow you would have bought that. But in general, from here, pullbacks, you would assume, are going to be buyable. People now have a slight change in sentiment, right? So a little bit different there. As for the performance of the S&P year to date, now it's down only 15%. That doesn't sound so bad after where we came from there, huh? Not so bad. If we look around the markets here today, you're going to find a few things going on. First of all, it was a tech-led rally. There's the semiconductors moving outside of its range there. Second place comes tech, the big tech stocks, and that's why, because they thrive on lower or stable interest rates. And so maybe we're heading into that type of environment there. Communication services, which a lot of people argue there's a lot of tech companies inside of there or are trending towards tech companies. They also did well today, coming off at the bottom. Very poor sector year to date. I'm trying to get that data for you and see, because they have not had a good run there. They are officially in last place still, down 33% year to date. So if you like the biggest discounted sector in the S&P, that's officially the communication services. Moving along here towards the bottom, I do want to point out real quick, the dollar still weak. You know that now, that when the dollar has a move like it did off of those highs, that it doesn't really rally. It likes to sit there and think about it a little bit, and that's exactly what the dollar is still doing. And then energy lags today. So energy was the weakest performer, although it's a 0.5% gain there. You're continuing to see the disconnect between oil and energy just on a really short-term basis. And remember, energy is hands down the best performer for the year. It's up 70%. That's not normal. There are not years where the energy sector was up 70% and then just magically finish the year there without pulling back. So a lot of people are starting to get into that year-end, maybe I'll take some profits on the energy sector sort of mood there. So I want to talk about maybe a sector that you don't want to be overcommitted to. Anyways, what do we have? Hey, seasonal data. So we often cover this with clients here, just so you know, like general stats, like how's the market perform in April? What's the normal move, right? Average move, median move. How often is it positive? Well, if you're looking at the S&P there and you had only 1 month to invest, you got to pick a month, invest for that month, and then get out. Imagine you did that for 50 years. Pick a month, get in, get out. What would be the best month? Well, it's not going to be December. December ranks as the third month. 88% is the 50-year gain you would have if you only invested in December. That ranks in third place there. Anyone want to guess what the top month is by chance? I'll let the stream catch up. Let's see who can guess it there. I'll tell you the answer if you can guess it. And by the way, back over here, if you're looking for the Santa Claus rally, if we go back to the S&P, if you were to do a intra-month composite chart, just for all you market geeks out there that like to do that, well, I did it. If you like to do that, you're going to find that historically the Santa Claus rally starts between the 14th and the 16th of the month. It's when it really starts to pick up steam. So don't expect that we hit December and then just whoop, we take off and everything's good there. Between the 14th and the 16th is where you want to look at. All right, moving on over to the Dow. There we go. Speaking of seasonality here with the Dow, obviously it's a great day for the Dow. This is still the best performer for the year. The Dow is still down about 5% year to date. So very much could turn positive. It wouldn't be normal because in the month of December, the average gain for the Dow is 1.52%. It is positive 74% of the time if you're looking back 100 years. So I wouldn't put it past it this year to see a 5% rally in the Dow, but that would be odd. It'd be, normal for it to be positive, but by 5% for the whole month, that'd be a big, big move for the Dow. This week, our Wine and Wealth, that comes up tomorrow. Actually, we'll be talking about a new feature here at Jazz Wealth, something very cool that you'll be able to use. Just happened to check in with Charlie to see how things are going. It's awesome, and we are in the testing mode of that, so we'll go over that tomorrow there. All right, sector-wise. We haven't covered sectors in a while. Right? Sector-wise, energy's best, communication services is the worst. The second best performer in the S&P is consumer staples. There's been a big shift this year away from discretionary and into staples. Consumer staple stocks have done well. We have also shifted away recently from energy to industrials and materials. The bad news is most people don't like looking at those industries there. So if you're curious, you would actually go on over here. The most popular ETF to look at industrials is the XLI. You can see the shift there. Obviously, in the short term, it has performed much better than the S&P and much better than other areas of the market. And materials has done the same, XLB, right? So if you're new to investing or trading, look at here since October, which is when the market put in a low. Okay, I see the rally there. Now let's look at communication services. Ooh, that doesn't look like such an impressive rally compared to industrials. Ooh, okay, right? So that's a quick way to see where's the money going, right? Give you a little heads up of how things are going like that. I want to cover something interesting real quick. I'll go real quick on this. Chevron. So this is the type of data that we get access to. This is phenomenal. So if you don't know, we work with Goldman Sachs. We are an independent financial advisor, but we use Goldman Sachs as our custodian because I want the best tools that are available typically to people that only have $20 million. Did you know that? In order to go knock on their door, you got to have $20 million. So obviously our clients don't have that, but as a company we do, and so we're able to knock on the door, and I love it. Anyways, CVX, we get the news they're going to be able to drill in Venezuela and go get some oil and bring it back, and then that's going to help our oil prices. Agree or disagree, that's what's going on. Goldman Sachs says, we have some questions. And so they actually held a dinner with the CEO and the head of investor communications to talk about this. And then they wrote it all down. So this is what we talked about, and this is what they talked about. So we get like the insight. It's like we were sitting right there. It's just fascinating to read this. But anyways, some of the things from the Chevron dinner is they said refining is likely to move out of the declining cycle faster than any other area because they already have so many projects in the works around the world. So what does that mean? The actual quote is, refining likely to move towards mid-cycle the fastest, given that there are still a number of large planned global capacity adds. I just broke it down for you. That was a simple way to say it. So what can you get from that? If they're making that move because they believe that that portion of the industry is going to recover fastest, they're committing their money to it. Well, wouldn't we want to go look at refining companies out there? Maybe they would benefit from that as well. So they were giving you the hint there. Oil will take longer because of how much money it takes to get that up and running, the length of time to get it out of the ground and everything. And they said liquid natural gas, they are the least excited about because that's going to take them the longest to get back to making really good money from that stuff because of what's going on in Russia there and the volume of products that are not moving, liquid natural gas anyways. Then they say, well, we see a need for consolidation across the industry, but we're mindful of the commodity price cycle and valuation in terms of pursuing potential deals. What does that mean? They want to buy somebody. They were focused on their balance sheet. They got tons of money on the balance sheet. They are mindful of how costly it can be and how oil is currently pulling back. But they basically just said, we're open to maybe buying a few companies, seeing if we can scoop up some stuff. Do you think, if you had to guess what type of company they'd be looking at buying, what kind of company do you think? Do you think it would be an oil driller, an oil service stock, an oil transportation stock, or a refiner? They just told you, right? So it's clear as day, except they use big college words and everything. So I, make it smart and kind of bring it down there for you. And they're focused on their balance sheet and, of course, paying dividends and continuing to do that as well. So how awesome is that? I was just reading through it and I was like, it's like I'm right there. Those are the questions I would have asked too. I'm like, that's amazing. So I wanted to share that with you. And then we had a question yesterday about supply chains. I'm going to go through that here in just a second. But before we do that, let's do stocks in the news. First up, you got DoorDash. Not a bad day, right? Made the announcement. Well, this is kind of funny. So DoorDash says, we're going to probably have to fire about 1,200 people. They make the announcement, right? And then they said, we'll notify employees in 15 minutes. I've never heard that before. So they put out this PR push that says we got to get rid of 1,200 people. And then at the bottom, it's like, and we'll just tell our employees in 15 minutes. I might have been a tough 15 minutes to sit around like, oh my God, am I going to get this email or I still have a job? What's going on? Hewlett-Packard. That is a very strong day for them. There's about 8 other times in history that it has gained 8%. Remember, this was spun off, though, so the data's somewhat limited there. That's great. So for them, they obviously, it was a three-peat. You know how I talk about beating on earnings, beating on revenue, and raising your guidance. They did it. No mention of share buybacks that I caught, but still a really strong day, and that would be a way above average day for them, for sure. Workday, they're doing a $500 million share buyback. Well, remember just the week of Thanksgiving, we talked about that? How do stocks perform when they do buybacks? Do they go up, down, or sideways? They go up. Micron, what was the note on that one? It says their pricing has trended below levels from their expectations on the last earnings call there. Didn't seem to matter. So a little bit lower pricing. Maybe people are believing that there's some higher margins there. It looks like Mizzou says that the margins will be a little bit higher. And so lower pricing is fine. I didn't catch all of that, but at least you know the news there. And Intuit. So these guys, oh, well, you know what Intuit is, right? They own QuickBooks, QuickBooks Online, QuickBooks Payroll. They own MailChimp. What do they do? What's the other one? Credit Karma. They just paid $8 billion for that a couple years ago. And so Intuit comes out with earnings there, and it was sort of initially mixed there. Initially, the stock had moved lower, and that was after hours yesterday. They had a decline in revenue from Credit Karma. Remember, it cost them $8 billion to buy it. So we don't want to see that you buy something and then you are not losing money, but not making as much money. Revenue was up 29%, which was an easy beat there, and margins are now up to 25%. Here's how you break this one down. Intuit has a handful of different companies now. 50% of their revenues come from their most important assets. QuickBooks, Payroll, their MailChimp, and payments. QuickBooks payments and inside of their Intuit payments there. So that's where 50% of their revenues come. Outside of that, you have TurboTax, Credit Karma, and the rest of them there. So just that portion of their business grew by 38%. That beat by, you would say, 700 basis points. To make it sound big, it just beat by 7%, right? Oh, that's a big beat there. So really good job for them. Very cool and good job. Yeah, I guess you guys use them to pay your taxes, right? TurboTax, you guys use those things. Tonight, have you been enjoying the Jazz After Dark? Well, tonight we're going to talk about the S&P's truthful returns. Do you know how much the S&P returns? What do you expect when you invest in it? Everybody says invest in the S&P, and you go, okay, well, what's the return I should be expecting? Did you know that less than 7% of the time you will see the actual average return that you've been told to expect? I'll go over all that data here tonight with you. I might even have some charts and stuff to show you the actual real returns there. Lastly, I got to hit one thing here. We had the comment from the other day. Supply chain. Ooh, is it going to be a problem? Is it not going to be a problem there? I'll give you a way to think about it. I didn't have a lot of time to go into it, but what I did is I said, okay, let's look at every single company and see how many times they reported the words supply chain disruptions. And then let's look back through all the different quarters and see, are they saying it more or are they saying it less? And here's what all of that boils down to. Here's the amount of times that this has actually been said in each individual quarter. So this last earnings quarter here, you have 59 times that it was said, the words supply chain disruption throughout that. That is a pretty severe decline from the quarter before. And of course, you can remember what was going on here, the whole mess that we went through. So just showing you that companies believe that supply chain disruptions obviously are not hurting them as much, and they're seeing that. I chose to go this way to identify it because then it's not an opinion. That's how many times the company that has their revenue directly affected by supply chain disruptions would mention that. And so we're on the downtick there. Very, very cool. One thing I do want to point out, I think it's right here. We did a satellite. I didn't do this. This is through Reuters. Satellite scan of all the ships that are out at sea. They have to be out at sea at least 100 miles, and they have to have been there for at least 3 days. And we found that on the East Coast, there are 42 ships that are, they call it a backlog. So 42 ships that are currently backlogged. They can't come to the port because there are other ships there. That's how you get supply chain disruptions. Over on the West Coast, that is not the case. They are down to 5. What can you learn from that? Well, over on the East Coast, there are 42 ships waiting to deliver stuff, but they can't because there's other ships in the way there. All right, who's going to deliver the stuff once they get it on the land, right? Is it J.B. Hunt? Is it a railroad company, maybe? Is it a trucking company that I haven't mentioned yet? Right, so where are they going to do better? Whatever trucking and railroad companies has the majority of their business over on the West Coast is cranking business out, right? The ships aren't backed up. They offload them, send it on their way. Offload them, send them on their way. There's only 5 ships stuck over there. On the other side, East Coast, we got 42 ships stuck out there. why is it stuck, right? We're not getting anything done there. So is the East Coast going to do better, or are people on the West Coast that have the business on the West Coast, such as the trains and the truckers, which one of those is likely to have a good quarter coming up, huh? Well, that's a different way to think about it, and a different way to think about a couple things. That's my job here. Share the data with you instead of saying, I don't know, I think that stock's going to go higher. You could put the pieces together. It's maybe a little more interesting than just rattling off a bunch of stocks, huh? You guys will tell me what you think. The internet is very good at giving their opinion, right? I know you will. As for the best month, let's see. Financially Free guessed it right, and so did J-Dub. April is the best month there, and if you give me a second, I will tell you exactly what the numbers are. But April is first, November is second in terms of performance for one single month. And in the month of April, well, if all you could do was invest in the month of April, you have, over the last 50 years, 109.4% returns. November is 92.7. The worst month is, you know it now, we just went through it, September. If all you did was invest in the month of September and that's it, you would be down, after 50 years, you would be down 42.2%. That would be really frustrating, right? Because that's a lifetime and you pick September. Now, nobody does this, by the way. It's just a fun stat, right? Just something fun to share. But there you go. So you got two winners there. April with 109.4%. There you go. Yep. George says, so you're on your way in the middle of a delivery, then you get a notice you're laid off. Do you just turn around and go home, or do you finish the delivery? That sounds like some kind of riddle. What are you delivering? I mean, is anything good? I don't know. Financial advisor. Not an ethics advisor. But if that did happen to you, man, I hope you continue the delivery, right? Got Christmas coming up, stuff. Oh, DoorDash? Oh, from DoorDash. Yeah, thank you for that over there. Yeah, so you're in the middle of a delivery, you get the 15-minute email there. Yeah, I probably just eat the food, huh? So that's interesting. Oh, man. DIYer, I'm glad you liked it. Different way to connect information. I'm trying to take rather than the normal retail view of analyzing stocks, what's that sort of institutional level? They're looking at satellites. There's literally satellite pictures on the platform. You can pull it up and it'll be a screen, and you just kind of hover over the ships. It'll tell you where they are, who they are, I'm sorry, and how long they've been sitting there. I like it. Yep. Ooh, you guys are brutal with the DoorDash people, man. I think most people would probably do that, though. Yep. Oh, man, there. So, yeah, a couple good lessons there, right? Refiners. I don't know, like, I would have to dig deeper into that to see, like, okay, who's a refiner that would be attractive and isn't riddled with debt or whatever Chevron's going to look for. But you learned how to look at it that way, just from a different thing there. We got transportation in there. We got home prices. Lots of data to share with you there, and I love it, man. I hope you enjoyed it. I enjoyed it as well. Always fun when you spend all this time putting something together, and well, it just takes 20 minutes, and it's all done. Hope you got something out of it, and maybe hit the subscribe button for us, would you? We're trying to make ourselves look a little bit bigger, and that's a nice way of asking you. If you just hit that button, the number goes up, and, you know, makes us happy. Enjoy the rest of your day, guys. We'll see you again tomorrow. Adios.